What I want to chat a little bit with you today about is some of the changes, and I sat this morning through some of the panels that talked about, obviously, technology, talked about the environment, sea levels rising. So we're really in the midst of major changes going on, and I don't have to tell you any more than that to actually realize that the next step is, how are those changes impacting the economy, how are they impacting us, and by extension, commercial real estate. So I have this up here only to reinforce the fact that 2017 is, in a sense, a very different year, if for no other reason that it comes in the wake of 2016. And that's not saying much, other than we've had major changes both in the US but also globally. Domestically, we've obviously had a watershed moment in politics, where we have both the executive and the legislative branch of the government controlled by one party. When that happened in November, people asked, oh, well, how long has it been since that happened? 8 years, 2008. We had the same situation except to the other side. However, that obviously has meant major changes. We're all sort of looking to Washington, trying to divine, are they or are they not going to repeal, replace, or something with the Affordable Care Act? We just had the executive decision come this week. Is Washington going to or not going to enact tax reform? What does that mean for everything from income taxes to Section 1031, like-kind exchanges, and so on? In addition, on a global stage, we continue to have conflict. We continue to have varying degrees of economic performance, all of which play a major role in the US commercial real estate markets. So just as a brief high-level point, how's the global economy doing? Well, IMF pegs it at about 3.4% for 2017, which is to say fairly moderate across the developed economies. On your left, you'll see US, Canada, Euro area, Britain, and Japan, all in a 1.5 to roughly 3.5% range. US actually, comparatively speaking, looks pretty good. On your right, you have emerging economies, a lot of Asian countries, which are obviously outperforming. But I want you to look at this only briefly. When you see China at 6.9% GDP growth, realize that 5 years ago, that was in the double digits. So obviously, we're seeing a very different economic environment. Again, that has an impact because in a country of blind men, the one-eyed man is king. So in a world of moderate economic growth, the US, even at a slow growth pace, is actually a very, very attractive market, especially for global investors looking for, if nothing more than two things, safety and some returns. So with that, and speaking of that, especially the returns, what I have here are interest rates for 10-year government bonds across the world. US 2.3%, Canada 2.1%, Britain 1.4%. Those actually stand out. Why do they stand out? Only because when you look at Japan and the Euro area, they're still hovering a little bit above zero. So 2016 was another watershed year in the wake of which we find ourselves, in that central banks resorted, as you know, to negative interest rates. Basically, you're paying to keep your money safe. So that quantitative easing actually continues to this day in Europe, which is in stark contrast to the US. And I know you follow financial markets. Again, watershed moment, the Federal Reserve here in the US decided not only to hike interest rates as a way to stop quantitative easing this last couple of years, but this year they've also decided to let a lot of maturing loans on its balance sheets, mostly treasuries and mortgage-backed securities, basically mature, roll off, no reinvestment of those profits, in essence signaling that the US market is in a much better position than it's been. With all this money and all this quantitative easing for the last at least 7 years, we've been, at least some of the analysts have been very concerned about inflation. And my only question is, inflation, what inflation? We're still trying to find out where the inflation is. In fact, some of the academic economic journals that I'm reading are all trying to answer this question. Where is the inflation? Where's the money? On the right side of your screen and in the back, you're not going to see very well. You see two very tall bars. One is for Argentina, one is for Venezuela. And for Venezuela, I just have an arrow, partly because you wouldn't see the others if I were to put it to scale. Understandably, given the country's geopolitical developments, their economy is not in good shape. But this, as you'll see a little bit later, plays a very important role in US commercial markets. So with that, let me transition to what I consider to be one of the more important slides in my presentation today. And it looks a little bubbly, so if you're not getting champagne with your lunch, don't blame me, blame Paul. What this shows you basically is the rate of globalization and, just as importantly, urbanization across the globe. What we're living in today is pretty much an urban world. On your left, you see the US, Mexico, Brazil. Most of the Americas, in a sense, are highly globalized. The red bars denote higher degree of globalization. In fact, the US today is over 82% a global country. So you're looking at this and you're saying, okay, I get it. Most people are living in the cities. That's pretty evident. What's not so evident, and where I find that this is an important chart to remember, is that along with this process of urbanization, there are a lot of frictions and changes coming along. Think about the US alone. Over the last 100 years, what has been the narrative underpinning American society? It has been the discovery of America. I'm just hitting some broad points. It has been the movement westward, go west, young man. And it has been the idea of the American cowboy being able to, on his own, traditionally, take care of business, right? So when you live in an urban environment, in a city, how many of these narratives necessarily hold true today? How likely are you as an urban cowboy to take care of things on your own? Are you going to pump, well and dig the water? Not likely. The same narratives are actually being changed across the world, from Europe to Asia to South America. All of these have a very important thing. Why? This morning you sat here and you heard about the impact that millennials are having on housing market, commercial market, financial markets. These millennials today were mostly born in urban or suburban environments. For them, the idea of the wide open spaces out west and the cowboy riding, which became translated into the automobile industry boom of the mid-century, of the 20th century, is not as pertinent, not as present as it was for generations before. So obviously, this urbanization is going to have much longer term impact on us, on the business of real estate and the economy in general. So the good news for the US, however, remains that population continues to grow. In the last decade, we've had 9%, almost 9% population growth. Why is that important? What drives the economy? What drives commercial real estate? What drives employment? It's people. At the end of the day, and this morning I listened intently, as a lot of folks are talking about the impact technology is having on our economy. Are robots coming for our jobs? Are technology companies rushing to replace employees with solutions that don't require employees? You got to understand, at the end of the day, behind all this technology, we have people. People who are simply looking for more efficient, lower cost, higher profit solutions. So at the end of the day, it's people dealing with people through the medium of technology that have an impact. But a growing population is important because without it, there's no growing economy. If you want a prime example of this, look at the economies of Europe, countries like Italy, Spain. Look at the economy of Japan. Declining birth rates are not going to get you a whole lot of economic growth. That's another reason why the US is such an attractive market for global investors in commercial real estate. So this population growth, however, has been accelerating the pace of demographic change. And again, this morning focused a little bit on millennials. What I have here, and it might be a little hard to see, but the blue slices are the composition of the silent generation and baby boomers, which today make up roughly 35-36% of the US population. Think about that. The majority of Americans today, in essence, are under the age of 50, and that, to me, is a very positive signal. Whether millennials want to own a house or not, whether they want to drive or not, the important thing is that even beyond them, you're looking at Gen Z, those that are basically, under 20 years of age, 26% of the US population, over a quarter, is made up of people under 20. That is a tremendous opportunity coming along behind the much talked about millennials. So why is this important? Because this demographic keeps consumers at the heart of US economic growth. So when you look at GDP, roughly 2/3 of it, 70% or so, are made up of consumer spending. And in fact, over the since the recession, the one thing that has constantly pushed the economy forward has been the resilience of consumers. Even with stagnating wages, even with initially low credit, even with a slow housing recovery, consumers have actually maintained GDP growth. However, there is a downside to this population growth, and you heard it also talked about this morning, and that's housing. And for anyone in this room, that is no secret. When you look at household formation, and I have that number on your left side of the screen, long-term, historically, over the last few decades, we average about 1.2, 1.3 million new households a year. Kids moving out from their parents, kids finishing college and getting a job and getting an apartment, whatever it is, new households average a little over 1 million. During the recession, that dropped below 400,000, but it's been coming back towards long-term averages. What you have on your right are new home sales and new home starts. And you can tell that that has returned nowhere near its historical norm. In fact, the average new housing starts over the last few years are between 600 to 800. So let's go with 700,000 new homes a year. So you have 1.2 million new households, 700,000 new homes. There's a huge gap of 500,000 every year. So not surprisingly, this shortage has led, as you well know, to two things: shortage of inventory, which automatically drives prices upward. So we end up with a situation in which a lot of first-time buyers, young people, are not able to actually purchase a home. So then my question to you, and again, I referred to some of this morning's discussion, is it that millennials don't want to own, or is it that they can't afford to buy? And whenever we survey them, so working for the realtors, we run surveys of consumers. We started a couple of years ago. And we've been asking young people, what is their interest in owning? Over 80% of millennials say they're interested in owning. And when we ask them, so what is preventing you from doing that? Number one, student debt. And number two, the cost of purchasing. And I've been here this morning. Miami is growing just like the US, 10% over the last decade. So obviously all this influx is being felt. So in terms of who's benefiting from this, anyone who's invested in financial markets, real estate markets, is certainly deriving a direct benefit. You look at household wealth tied to financial investments is at a record high as of second quarter, over $78 trillion. You look at wealth tied to real estate, again, it has surpassed the prior peak. All good news for people who are in these markets. However, if you are not invested in financial or real estate markets, you are dependent on your income, wages, which have been stagnant, and you're also impacted. What I have on this map, on your right, is debt by holder. And the only line I want you to focus on from the spaghetti of lines is the red one. That indicates debt held by the federal government. So student debt. In 2000, aggregate US student debt was $89 billion. As of August, so 2 months ago, aggregate American student debt was over $1.1 trillion. So think about this. Your average student comes out of college with about $30,000 in student debt. Incidentally, that's actually about the cost of a brand new car. But if that student, which is very common nowadays, went to get a master's degree, get an MBA, get a law degree, go to med school, their student debt is likely to be anywhere between $100,000 to $300,000 plus. So we're asking these kids to go out and buy your medium-priced home at $260,000 when they already have, in essence, the equivalent of a mortgage that they're carrying around. So don't be surprised that millennials are a bit slower to get started in the economy. And incidentally, actually to bolster my good news, the one thing that one of the speakers mentioned, what drives home purchase? Getting married, having kids. So what are millennials doing right now in increasing numbers? Getting married, having kids. Guess what they're buying when it comes to vehicles? These are people that were not expected to buy vehicles, right? So the auto industry is tracking what they're buying. Why? Because they got married, have kids. SUVs or crossovers, right? Because we have much sexier platforms nowadays than the old, hulking Suburbans, though the Suburbans are very popular. So what are they buying? SUVs. So they're not that different from prior generations. So don't let a lot of advertising fool you into thinking that millennials are simply going to abandon the US economy. So from my perspective, that's actually very encouraging. So the other good news of all this growth is employment has been maintaining momentum. We are over 2 million net new jobs every year, and that's finally showing up in wages. So we've had now for 2 years wages go up at about 2.1% adjusted for inflation. Again, the downside is housing is appreciating at 6% a year, but nonetheless, having inflation adjusted wage growth is important. And just as important for commercial real estate, most of this employment is in industries that need office space, industrial space, and ultimately end up impacting retail space as well. So unemployment, again, hovering a little bit over 4%, 4.2, has been driving consumer optimism upwards, which is the linchpin to consumption and ultimately economic growth. So how's that translating to commercial real estate? And I want to point out something that to me is a key as we're looking at what a lot of people are talking about, the maturing of the current real estate cycle. On your left, I simply have the graph of the 10-year bonds, right? You're looking at risk-free investment return. Your government bonds are going to provide that. On your right, I have historical ratings of the capital markets investment alternatives from Citus RERC, and you have stocks, bonds, commercial real estate, and cash. Traditionally, you have basically stocks providing the highest risk, highest returns. You have bonds providing lower risk, lower return. And commercial real estate has been roughly in the middle. If you look at that graph, the only line I want you to focus on is the tan one that goes up from about 2009, end of 2009 to into 2010. Commercial real estate has outpaced stocks, bonds, or cash in terms of investor preference. And I'm preaching to the choir here, you know better than anyone why. It's because of the returns that investors have been able to generate in this upswing cycle of commercial real estate. And for me, that actually spells good news going forward. Not only has commercial real estate been recognized with its own code for stock investment purposes, so the REITs have gotten their own code in financial markets, but commercial real estate has become, in a sense, a mature product for global investors. And the US, as I'll briefly show, is at the epicenter of that. So what is underpinning this? Stemming from economic growth, stemming from population growth, we're looking at the leasing fundamentals. And what have you seen? Again, I didn't want to come with graphs, and even the words, I don't need you to focus too much. You can see this later. Across all core property types, we've had very well-performing fundamentals. Whether you look at net absorption, vacancies, rent growth. Office was a little slower out of the gate over the last few years, but vacancies have finally declined under 12%. Just as importantly, suburban office space, which was written off as dead about 6 years ago, has actually come back in vogue. We're seeing a lot of demand in suburban spaces. So office is doing well. On the industrial, I remember sitting in a presentation that someone was calling industrial not a very sexy product. Well, frankly, industrial has been one of the hottest products, and Miami is probably at the epicenter of that. One of the hottest products to perform over the last few years. And I was in Greenville, South Carolina on Tuesday, and the Port of Charleston, their CEO was there talking about the Port of Charleston, what they're doing to basically compete with Miami. But why? Between global trade intensifying and the rise of electronic commerce, industrial properties are the hot commodity right now. And retail, obviously we've heard all about the department stores closing. So they're closing for a simple reason, frankly. A lot of the retail space has been overbuilt. In the 60s and 70s, a lot of malls were put up throughout the country. which in this environment no longer sustain it. But I wouldn't write retail as off because there are so many layers within retail that are doing very well. I'll mention grocery stores. If you haven't read it, we seem to be in the middle of a grocery store war in the US between the traditional grocers, the new 800-pound gorilla Amazon through Whole Foods, and then the new European entrants. And I only say new partially because you have Aldi, which has been here in the US for at least 30 years. But you have the newer entrants like Lidl, another German store, which are all actively competing at the neighborhood discount level and completely changing a lot of the drivers for retail spaces in that. And of course, on the apartment side, I'll only briefly mention that yes, millennials love apartments, but so do a lot of people who live in urban areas. And when you're faced with really high rising cost of homes, with tight underwriting, still very tight. FICO scores for mortgages are over 700 on average still. Before the recession, they were in the low 600s. So you need stellar credit. Are you going to have stellar credit if you're 24 years old and you have $100,000 in student debt? Not likely. So that's obviously kept apartment demand solid. Vacancies are increasing across some of the markets. Like DC, where I'm based, we've been building apartments for the last few years like crazy, so not surprisingly, vacancies are moving up, but demand is solid. So what are global investors doing? Last year, they basically got a little concerned. We had Brexit, we had so many things that were happening. They were keeping an eye on the US elections. Still a lot of uncertainty around the world. So last year, sales volume was down 11%. So far, in the first half of this year, we are up 5%. A little over $600 billion in deals. A lot of that deal making is happening in Asian markets. That's the orange bar on the graph. And as I mentioned, even in terms of acquisitions, Asian buyers right now are the dominant drivers of markets across the globe. And we have obviously Europe, Canadian, Middle East, and so on. So in terms of global investment, institutional investors remain the driving engine behind it. You can tell that even with a declining sales volume, they comprise the bulk of investors looking at global space. And within institutional investors, the one interesting trend has been that banks have been losing ground. So right now, the space is mostly divided between insurance companies, professional managed funds, and pension and sovereign wealth funds. And incidentally, as I mentioned to you, we have an increasingly urban population. And one of the other factors I didn't mention for that slide, think about this. If you live out in a rural environment, you tend to be a lot more self-sufficient, and a lot of your wealth, whatever it is, tends to be tied to land. When you move in an urban environment, you're more likely to depend on employment and the wage. And in developed countries, what does that come tied with generally? Retirement savings. So if you're an employee in the US, you are more likely to save money in a 401k. In Australia, there was a speaker who was from Australia here earlier. In Australia, you're required, as I understand, to contribute to the pension fund nationally across the board. You have Norway, another strong pension fund. Same thing in Canada. Why is this important? In an urbanized world, you will have a lot more people directly or indirectly invested in financial markets, and as of 2017, in commercial real estate markets than before. Why is that good news? You have more buyers of commercial property today than we had even 5 years ago. A lot of these pension funds are very active in this space, and they will continue to do so. Why? Their liabilities are long-term, their balance sheets, their outlook is long-term. Real estate, and especially commercial real estate, is an ideal product for that. And if you've dealt with insurance companies or pension funds, you know that sometimes their terms on prepayment penalties and some of those things are pretty strict, partly because they want those cash flows long-term. So this is one of those charts that you might see at your optometrist when you go to check your eyes. So I don't want you to focus too much on it. I only have it here because it shows momentum. Increase in volume, increase in prices. Where is the money going and where are prices? At the very top right, you have the Czech Republic. And then you have Spain, you have Singapore, South Korea, Germany, China. These are markets which have strong economies and where investors right now are likely to realize the highest returns. And the big circle, light blue in the middle, is the US market. That's one of the reasons I put this chart up there. So don't worry about the labels, just focus on the bubble sizes. You can tell the US commercial real estate market continues to be the dominant global market. And to me, that is good news for investors in Miami, in DC, or just as important as I'll show in a moment, in even smaller markets. So with this size of the US market and the global flows, US remains in the lead. So out of the top 30 markets, roughly 15 to 16 are US-based markets. You see Miami is in the top 15. Investing in Miami from global standpoint slowed down in the first half of this year. But what's interesting to me, and again, don't worry if you don't see this chart all the way in the back, I'll talk you through it and you'll see it afterwards. What to me is interesting about this, we're seeing a brand new, at least from a historical perspective, spotlight from global investors on secondary, tertiary markets. Places like Austin, traditionally qualified as secondary. Austin, Orlando, Denver, markets where global investors have realized underpinning economics are strong, volatility during the cycles is much lower, and right now the yields are much better. So on a national basis, average cap rates are 6.8% based on Real Capital Analytics. We run a quarterly survey where we ask realtors what are cap rates in your market by property type, and then we aggregate them. Right now, cap rates in realtor markets, generally secondary, tertiary, are 7.2. That spread was even higher about 2 years ago. So obviously, investors are finding out that you can get a really good return in Nashville, and Nashville, by the way, is a very, very attractive market right now, or even Indianapolis or places like Jacksonville. So office and apartment are mainstay of global investors. There are product types which are pretty clear across most countries, easy to understand, and where demand has been solid no matter the country. I put up there industrial. So for the first half of the year, industrial is down 3% in terms of sales volume. But in the second quarter, industrial sales actually picked up. They're up 8%. And to me, that's a clear signal that we're going to see a continued interest in industrial properties, which for the Miami market obviously is a very important market. And in terms of transactions, the US obviously leads, but some of the other countries, as I mentioned, are very much all located in Asia, or if they're in Europe, a lot of activity outside of Germany tends to be at the periphery. Spain, Czech Republic, Poland, Ireland, countries where the economy has recovered to a point where investors are seeing some very strong returns. One thing I will want to underscore, however, the US remains a tale of two markets when it comes to commercial real estate. You have the large cap markets, investment grade assets, and then you have the small cap markets where your valuations are lower, the market geographically may be off the coast. And when you look at both investment volume, so sales volume on the left, prices on the right, what's important to note is during the recovery period, small cap markets have been lagging the larger ones by about 3 years. So 2010 marked the recovery in large cap markets, New York, DC, San Francisco. Smaller markets took until 2013 to actually see a pickup in sales prices as well as volume. Why to me this is relevant? Anymore I get calls almost on a weekly basis from reporters. Commercial prices are a record high. Are you worried about a bubble? No. Any other question? I mean, I have to explain a little more what I mean by that. But no, I'm not worried about a bubble, because my question to them ultimately and right away is, which markets are we talking about? Because there's not just one market, and commercial real estate is not just New York City. So in a lot of smaller markets, there's still quite a bit of room to go. To use an aviation analogy, we still have lots of runway left for those markets to grow. So if someone's worried about a bubble, if they're not investing in DC apartments or New York City maybe offices, they are in very good place in places like Kansas City, Austin, Nashville, or other markets, Seattle, to see good returns. So at the large end, obviously we've had stagnating prices. You look at cap rates, they've gone flat for at least the last, I would say, 4 to 5 quarters. So are moving between 6.8, 6.9% in a rising interest rate environment, which is where we've been dealing. So the Fed's pushing up rates, but those are short-term rates, right? They're mostly aimed at banks. So everybody's been watching the treasuries, and initially we had a bump post-election, another bump in January, but 10-year treasuries haven't moved much. But ultimately, with short-term rates moving up, those treasuries are going to move up too, which ultimately, what is it likely to do to valuations for anyone who looks at the classic formula, right? Value is NOI divided. So it's obviously going to lead to some flattening. And in fact, our forecast for the next 2 years calls for a flattening of prices in commercial space, again, at the large cap end. The one thing that to me is important in this current narrative about the cycle is secondary, tertiary markets are very much where a lot of the action is right now. So when you look at, and this again, Real Capital Analytics, deals aggregated 2.5 million and above, where's the volume and prices? Where are they growing? Non-major market hotels, non-major market suburban offices, and non-major market industrial properties. So you think about, these are right now the places where money is flowing. Returns, growing and solidifying fundamentals are driving a lot of this. And even when you look at in terms of sales volume, industrial was the one property so far in 2017 in the US to see increase in sales, and not just any increase, but 10% year over year in the first half of the year. So if you're an industrial practitioner in Miami, you're probably going to look at me and say, yay, that's great. I've been seeing that all along. So what else is new? But to a lot of folks who are not dealing with industrial properties, to them, sometimes this is quite surprising. So in terms of small cap markets, as I mentioned, the market has rebounded in 2013 based on realtor data. It had a small hiccup first quarter of this year, but it rebounded second quarter. When we ask realtors, what is your biggest concern right now in commercial markets? Number one, inventory shortage. Over 45% of members cite that as of the second quarter as their, actually, it grew even bigger in the second quarter. And this is not just a small cap issue. Even in large cap markets, there's a shortage of inventory, which from my standpoint, I think a lot of the decline in sales volume is simply due to the fact that there are people who are not selling right now unless they have to. In fact, I was in Las Vegas earlier this year and met a broker from Maryland, right in my neighborhood, who came to me and said, do you have any connections in the DC market brokerage community? I have a Chinese client with $100 million. I can't find him a building in DC. Which, I'm not a broker. I found that a little shocking, and I went back to DC and asked some of the DC brokers, and they smiled and said, if someone's sitting on a $100 million building right now, they don't want to sell it. What are they going to buy? Unless they have to, what are they going to buy in the DC market for that price? So anyway, to me, that's obviously a significant factor impacting some of the current market. So to move into what I think is the more interesting part of my presentation, and that's what are the trends in commercial international deals in realtor markets. And this data comes from a survey we ran. This year is the first survey we've ever done of international transactions in members' markets. We started with a fairly small survey because we're mindful of folks' time. But nonetheless, the data we got, to me, was very illustrative. So we asked them, have you completed a transaction in general last year, yes or no? 69% of members said yes, we completed transaction. In fact, we had an average of 9 transactions last year with an average value of $2.3 million. So again, it's very much illustrative of an active market. When we asked those members who had transactions, did you do an international deal? 20% of them said yes, we had international clients with deals. Why, to me, that's important? This is one question we've been asking for 8 years. on just a regular market survey, it's been fairly level. So realtors active in commercial markets, on average, 20% of them, 1 in 5, have international clients. When you look at Real Capital Analytics data for large cap markets, cross-border investors historically have been between 8 and 10%, a much smaller percentage of the market. It went up over the last few years. It approached almost 20% a couple of years ago, but it's come down. To me, this is relevant because it tells me that you and realtors around the country are way more engaged with international clients than some of the brokers at the higher end. So we asked members, did you have a buyer side, a seller side, or both? You can tell that 41% of realtors had a buyer side, 24% had a seller side, and then about a little over a third had actually both kinds of transactions. And on the buyer side, again, average 3 transactions a year, worth about $2 million. Sellers sold a little more expensive properties, $3.2 million. The important thing is international client type. We try to split to get a sense. Are they non-citizens who reside mostly outside the US? Or are they folks who are here on a temporary status, diplomats, students, or investors of some other type? Over 60% are foreigners who basically reside outside the country. Going back to my earlier slides where I showed you the interest that global investors have in the US market, this pretty much speaks precisely to that. So where do buyers come from? On your left, I have the major global regions. The Americas dominate, so we're talking Canada, Central, South America. Buyers in the US market dominate from there, followed quite closely by Asian buyers. And then Europe, with about a fifth of investors. Where do they come from by country? China, not surprisingly, is at the top of the list, accounting for about 17% of buyers, followed by Mexico, United Kingdom, Venezuela. And if Venezuela is experiencing inflation over 700%, I don't blame those folks that they want to put their money somewhere else. So not surprising, Venezuela is very active, followed by, in somewhat equal measure, Canada, France, Israel, South Korea, UAE, and Vietnam. Transactions in this space, in the realtor space, are mostly under that 2.5 million threshold at which some data aggregators compile. So 70% of deals are under 2 million. Now, it's worth noting that almost 30% of deals are above that, so obviously realtors are engaged across the full spectrum, but these are small cap markets in smaller communities. And importantly, what attracts these investors? Employment and trade centers. So number one for both buyers and sellers, Florida. Well, you've heard the reasons this morning, right? It's sunny, it's subtropical, it's fun, and it's happening. Between ports, between companies locating here, between tourism traffic, between simply population growth. The southeastern United States has been the fastest growing region in terms of migration internally within the US of any regions, and Florida is a main beneficiary of that. And I think for a lot of retirees, I mean, this has been obviously the case for many years, the taxation, state tax status has been favorable, but it goes obviously way beyond that. So Florida is number one, followed by Texas for both buyers and sellers. Texas, obviously, again, good tax treatment, in addition to lower cost of living, lower cost of business. Big news for office occupiers in the Dallas area. When Toyota moved its headquarters to Plano, they were excited. Why? Because when Toyota, like any major manufacturer, moves to a location, it's not just Toyota that moves there. There's an entire ecosystem that moves along with that company. And interestingly enough, I read an article that basically right now, if you go to Plano, Texas, you will find a heck of a lot of Japanese and Asian restaurants that weren't there 10 years ago. And with Toyota, in 1 year alone, which was last year, there were roughly 26 major companies that moved along. And these are suppliers or sometimes tangential companies. So a lot of these moves have a solid impact on those markets. California, Michigan, New York, and Arizona also make a good chunk of investments. So what drives this interest in the smaller markets? Number one, safety, and number two, value. In fact, when we asked members about international clients, 61% said their clients said it was cheaper for them to buy property in the US than in their home country. And for a lot of Canadians, for example, I'll just throw that, valuations for US properties, especially in Florida, are still actually cheaper than theirs. And that's the case for a lot of countries. And not surprisingly, most of the transactions are made with cash, 60%, and then 34% financing from US sources. That tends to be the case for folks who are residing in the US who can have access to those mortgages. Importantly, Florida realtors are very much above the national average in terms of being engaged with international clients. 30%, and that got wiped out, 30% of Florida realtors had an international client versus 20% at the national level. So you're obviously a lot more plugged in to the international scene. The average transaction values for Florida realtors are also higher than the national. We're looking at 2.3, 2.8 million. And the acquisitions made in Florida with cash are obviously much higher, which to me tells me that the type of investor comes here, looks for, number one, the return, but they also come with a much more liquid position. So in terms of how is Florida different than the rest of the country, I had actually a call with a member who said, I saw your report, it was nice, China is number one, I live in Miami, I don't think that that's representative of my market. So I looked at just the Florida subset of the survey, and sure enough, Venezuela is the number one buyer in Florida, not surprising, given the, again, political and economic instability. So in Florida, Venezuela, China, France, Canada, Argentina, the UK are major buyers, and I don't think to anyone in this room that is a surprise. In addition, what are these investors buying in Florida? Number one, apartments. Over 20% of properties acquired in Florida are apartments, followed by other. And when I looked in the other field, it's mostly medical type offices that folks entered. And then retail, land, industrial, and lastly, office and hotel. In addition, most Florida realtors are actually closing transactions with international clients. We've asked survey takers, have any of your members of your clients decided not to purchase? 34% said yes. I've had members who didn't want to purchase, but 66% said yes. When we said, why didn't they purchase? Number one reason, exchange rate. And that's the one thing I didn't mention, obviously, but it comes from the strength of the US economy. The US dollar over the last 2 years has obviously appreciated. So for a lot of folks, that's an impediment. The other things that were cited were immigration laws or visa issues, exposure to US tax law. Obviously, that's a major concern for some investors. And to a lesser extent, they couldn't find a property, the cost of property, or it was difficult moving money to the US. And I think we might see the impact of China's tightening of its capital outflow rules this year. We might see an impact going into next year from Chinese investors. So at the end of the day, what drives commercial real estate business in realtor commercial markets? Number one, personal contacts and referrals. When we basically asked, personal contact accounts for over 20%, 27% for sellers, 18% for buyers, previous client referral. To me, this is very important because, as you know, even better than I do, you're doing this every day, day in, day out. Personal relationship and satisfaction of your client will translate into future business, future income. The only thing this survey does is simply underscore the importance of personal relationships to the business. So looking forward, we asked members, what do you expect over the next year? And how has it changed for you, international business, over the last 5 years? And as you can tell, for buyer clients, over 40% said business has increased over the last 5 years. And looking out over the next 12-month period, 40% expect business to actually increase. So looked at it from a broader perspective, sort of the global macro perspective, US real estate remains very attractive. Values in the US real estate, even though they're rising, are still very attractive. And just as importantly for you, investors now are looking across the entire value spectrum. They're no longer just going to New York City to look at properties. They're going across the country and across the value spectrum. So with that, I'll only put this up here to let you know that at NAR's research webpage, There's a wealth of information, both on commercial, capital markets, taxation, as well as residential, where you can find a lot more information. And with that, I conclude my remarks. Would be glad to take a few questions if we have time.
We have time for 2 or 3 questions if anyone has any. You guys still digesting your food?
Fabulous. I've done such a good job. Thank you.